Welcome to the first part of our series on expected credit loss provisioning for trade receivables. Today, we'll discuss about the regulatory and accounting expectations in India around ECL, especially under Ind AS 109. You might be aware that a few years ago, India adopted Ind AS 109, our equivalent of IFRS 9, ushering in a new era of expected credit loss modeling. This was a big change from the old incurred loss approach. What does that mean? Under the old rules, you only recognized bad debts when there was a clear sign of default. Under Ind AS 109's ECL approach, you have to anticipate losses, essentially from day one. The idea is to be proactive, recognize credit risk as it builds up, not after the fact. So, every time you have a trade receivable on your books, you're expected to estimate the potential loss on it up front, using all reasonable information available. Now, this isn't just a best practice. In India, it's the law. Ind AS 109 is notified under the Companies Act 2013, which means medium and large companies and all listed companies must comply. SEBI's listing rules also reinforce that your financial statements need to follow Ind AS. So, if you're a CFO signing off the books and your company hasn't booked expected credit losses on a chunk of old receivables, that's a compliance red flag. In fact, regulators have pulled up companies for overstating receivables by not taking proper loss allowances. Nobody wants their company in the news for the wrong reasons, especially not for something as preventable as this. Let's talk about what Ind AS 109 actually expects for trade receivables. The standard allows a simplified approach for these. In plain terms, you don't have to track each invoice for a significant increase in credit risk over time. Instead, you always assume lifetime losses could occur. This makes sense. Trade receivables are often short-term, and many might not have formal credit ratings. So from the moment a sale is made on credit, you're booking an allowance for the possible credit loss over the life of that receivable. Many companies use a provision matrix for this, essentially segmenting receivables by age or customer group and applying loss rates based on historical and forward-looking data. And that brings us to a crucial point: forward-looking information. Ind AS 109 explicitly says that when you estimate expected losses, you can't just look at the past. You have to consider current and future economic conditions. Think about it. If you only rely on, say, the last 3 years of collection rates, you might miss warning signs of an economic downturn or sector slowdown that could make collections harder. So, the regulators expect you to incorporate things like macroeconomic indicators. If GDP forecasts are down, or if there's trouble in your customer's industry, your ECL model should reflect that. It's a more sophisticated data-driven approach to provisioning. Now, who is watching over all this? A few key players. NAFRA, the National Financial Reporting Authority, oversees auditing standards. They've put ECL high on their radar. Why? Because calculating ECL involves judgments, assumptions about risk, future conditions, etc. NAFRA has actually issued guidance for audit committees, suggesting tough questions to ensure management isn't too optimistic about recoveries. Auditors are expected to verify that the ECL models, like your provision matrix, are reasonable and compliant. So, audit committees are definitely asking CFOs, are we comfortable with our ECL calculations? Have we segmented our receivables properly? Used the right data? Then we have ICAI, the Institute of Chartered Accountants. They recently put out a detailed guidance note on ECL. This shows the profession's consensus on best practices. The ICAI material emphasizes the need for a strong credit risk framework and high-quality data. It's essentially a playbook for accountants on how to do ECL right. While it's guidance and not a regulation, you can bet auditors will reference it when evaluating your methods. Lastly, for the financial sector, the RBI. If you're in a non-banking finance company or any entity regulated by RBI, they too expect you to follow Ind AS 109 for provisioning. Banks in India have traditionally used older norms, but even that is changing. RBI has signaled that banks should prepare for the ECL model. So across the board, the direction is clear. What does this mean for you? If you're a CFO, finance manager, or compliance officer, you must ensure your trade receivables impairment process ticks all the boxes. Ind AS 109 compliance, incorporating forward-looking data, proper documentation, and so on. It's not just about avoiding non-compliance. It's about painting a true picture of your company's financial health. Remember, those receivables on the balance sheet aren't worth their invoice value if you expect some customers won't pay. ECL provisioning makes sure your accounts reflect that reality. In summary, regulatory expectations in India demand a proactive, well-documented approach to ECL on receivables. The accounting standard provides the framework, like using lifetime loss estimates and segmentation, and the law backs it up with oversight from bodies like NAFRA, SEBI, and RBI. This isn't merely a check-the-box exercise. It's about transparency and robustness in financial reporting.